All right, this is Hewlett Packard versus Corning. Now, what we're looking at currently is the historical performance of the portfolios, and they're going to look a bit different from the previous video where we did a market update. Reason being is because as the stock market prices and not only that, but companies' fundamentals and financials change, the program updates this information and thus changes the scoring of the portfolios and also what is in them. Um, so one of the biggest changes that I saw, which really kind of threw me for a loop. It doesn't happen very often, but it does happen, and it really threw me when it happened. I tried to figure out what was going on. So in the previous video, we were looking at specifically the down moves portfolio and the up moves portfolio. And for technology, we saw Intel, INTC, as well as IBM, I believe, in the up moves portfolio. And now we see GLW in both the down moves, and we'll see it also. I got to go the other direction. And we'll see it also in the up moves portfolio. And so the reason why is because GLW Corning is very close to that 2% dividend threshold that we have. And just to explain, so basically, a dividend is, let's just say 10 cents a year, right? And so if the stock is worth $1, that means that the dividend is 10%, right? Now, as the price moves down, that makes the dividend percentage increase, even though the dividend stays the same at 10%. So if the price went down to 50 cents, now that 10-cent dividend is something like, what, 20, 30%, something like that? Yeah, 20%. So that's what's happening, right? So GLW, and I haven't looked at this yet, but I should have to assume that the dividend is very close to that 2%. And so whenever the market price updates in the program, it changes whether or not we can even invest in GLW. Prior to this last update, we were not able to invest in GLW because the dividend was below 2%, even though it was, only a few points below 2%. It was still below 2%, which made it uninvestable for us. Now that it is investable for us, the program has said, okay, well now GLW we can invest in, so let's throw GLW into those portfolios in which it fits, and let's update the historical performance. And so that's what we see here. If you go back and you look at the previous video, you'll see that the performance for these portfolios is actually much higher, but it hasn't changed much. And so that does give me great confidence in just the numbers and what we're looking at here. So over the last 3 years, 3.5 years now, down standard deviation portfolio is the best performer at almost 70%. Down moves, which is the portfolio that we've been following this fiscal year, comes in at 61%. The trailing 12-month best performing is still up moves at a slightly higher 28%. And again, that has to do everything with replacing. Well, I can't say everything, but I will say that most of that increase, I'm assuming, is because we're replacing IBM with GLW. I didn't look to see if there were any other changes in the portfolio. That was the only one that I noticed. And I think the moves portfolio was like at 27%, and now we're seeing 28, almost 29%. We still see the beta portfolios near the top, and then we have down moves. I think like fourth place or something like that, which is actually better than what it was before. And again, that's because of replacing Intel with GLW. So what we're looking at then is either purchasing shares of HP, Hewlett Packard, or moving now into GLW Corning, which is what the program is called for. So let's take a look. at these two companies. All right, so they're about the same price, which is interesting. That almost never happens. And then as we see here, there's the dividend. Hewlett Packard is at 2.2, GLW 2.6. So very similar as dividend goes. Obviously, the price has moved around quite a bit for GLW. Matter of fact, let me take a look at just the previous performance. I'm gonna have to. There we go. So I am curious now. Let's see if it's moved around a lot or what's going on. But 2.6 and 2.2, they're both kind of right there. All right, so okay, so yeah, so that's what's happening. So as the price goes up, that brings the dividend percentage lower, and so I can't be certain, but but obviously that's what's happened here. So anyway, so that's where we are on the dividend, about the same, nothing to see there really. Hewlett Packard has obviously come from much further. 17 is the purchase price versus 26. The PE ratio, however, is still much cheaper for Hewlett Packard. GLW is really high, which I think really says something. I do also want to talk a little bit about what Corning does, and so they are a technology company, but they operate in a space. What they do is they manufacture glass, optics, laser type stuff, Gorilla Glass, which is very popular on a lot of cell phones and things of that nature, telescopes, basically anything optics related. Is where you'll find Corning. Again, these are, the largest companies domiciled in the U.S. And so basically, everyone is going to these guys to get that kind of material and that kind of work done. Um, I will say that maybe Hewlett Packard has not been very popular um, in the past, and that's why we see the PE ratio with such a stark difference. Corning and the glass and the optics and everything, I can definitely see that as being a hot industry, especially when you're talking about, cell phones and tablets and all the things that you'll need glass for, versus Hewlett Packard, where a lot of people are saying that, laptops and desktops are going out of style. Everyone's moving to their phones. So that is interesting that we have such a huge difference in PE ratio there. And it just means that people are willing to pay more for the GLW stock versus Hewlett Packard. I mean, that's just what that means. That's simple. As far as where that is relative to historical numbers, it looks like GLW is at the height of its 5-year PE ratio, whereas Hewlett Packard is down near the bottom. We see a negative PE ratio, which we've talked about before, is that can't happen. So yeah, I mean, just no question about it. GLW is close to the high, which means that if we purchase the stock right now, we'll be getting it at its probably absolute high. We'll look at that here in a moment. See net profit. Yeah, I'll say that these companies are comparable as far as that's concerned. They're basically manufacturing products and to sell them then to companies and maybe consumers as well. Return on assets, Hewlett Packard does have better numbers than Corning. Not sure what Corning's margins are, but it looks like Hewlett Packard is doing better in that regard. Hewlett Packard, more cash on the books. And I did talk about changing this to a percentage. I'm definitely going to do that. So next time we look at this, we'll have a better comparison. But because these companies are basically the same price, this is a really good comparison. Hewlett Packard definitely a little bit more cash on the books. And again, this is something that will change quarter to quarter as the numbers come out and the software is then updated. All right, cash to debt looks like Hewlett Packard wins there as far as not having so much debt. Short interest is important here. We know that just recently Hewlett Packard really crushed their earnings report. A lot of that has to do with winning a lawsuit that put quite a bit of money in their pocket. But as we can see, the share short is double of GLW, and that simply goes back to my original point that, a lot of people are betting against Hewlett Packard. They're saying that, laptops and desktops are going away, and so that's why we'll see, so many people willing to bet against Hewlett Packard versus Corning. All right, as far as the high, I am really shocked to see this. Hewlett Packard, again, with their super low PE ratio, is very close to their high, whereas Corning is 20% off its high. That is a big deal. Let's get a percentage here. All right, so yeah, Hewlett Packard 58% off its low. Corning 6% off its low. So, going back to the PE ratio, this is something that I definitely want to take a look at now, just because of the stark difference. I mean, for Corning to be at the top of its range as far as price to earnings go, it's near the low end of its price. So it's weird, but it's like you're getting the stock at a relatively cheap price relative to its historical performance, but relatively expensive compared to its fundamentals, compared to its balance sheet, compared to its profit. And so that's interesting, and I definitely want to take a further look at exactly what those numbers look like for Corning before diving too deep. Alpha is better for GLW, so that is good. Up moves better for GLW. That's really good. We know that portfolio is performing better. And then down moves better for GLW, which we expected that. But it's not far off. Not far off. 42 versus 50. The beta is better for Hewlett Packard than GLW, and that's important because we've seen that those beta portfolios are performing fairly well, and I will venture to say that this is quite a big jump compared to what we see in the difference between up moves and down moves. Monthly return about the same, I'll say. Volatility, Hewlett Packard's a bit more volatile. I have to imagine that has a lot to do with the recent price movements. Then, of course, we see the score here in GLW scores better than Hewlett Packard. Management score, Hewlett Packard wins over GLW quite handily. And again, it has to do with cash on the books. So, at the outset, we're not really going after beta, right? I mean, those beta stocks are companies that perform well when the market isn't performing well. And so you really kind of want to go there, right, just for safety. But again, we're following the down move portfolio, and GLW wins there. And we also know that the up moves portfolio has been performing the best as of late. And so we definitely want to look there. I think we have to stay away from the beta. The other thing to note here is that those beta portfolios, I'm calling them beta portfolios, but in reality, there's a lot more going on than just beta, right? So we see beta return alpha, beta alpha. If we want to find a pure beta play, see, this is beta return. So basically, we're looking at, performs well when the market is not doing well, but is also has this growth potential, right? Alpha and return. If we look at a straight beta play, I mean, it's way down here. So yeah, yeah, it's pretty far down there. I mean, my goodness, there we go, pure beta. Um, 2% last 12 months. That's horrible, considering where everything else is going. So, yeah, up moves and down moves, I think is where we have to really stay in regards to this. I am curious though as to what the numbers look like and why there is this huge difference in PE. But like I said, the price is pretty low right now. Typically, when you just think about the math, right? If you have a small price, okay, and you have a lot of earnings, then that will make the PE ratio small. In this case, it appears that the earnings have lost more faster than the price has. And so that's something that we definitely want to take a look at and make sure that we're not getting into any bad situations, right? Um, Hewlett Packard is the sector leader as far as returns go. Um, Both the up portfolio and the down portfolio are calling for GLW. Let's take a quick look at, oh, excuse me, one of these other portfolios, just because I am curious. Let's see. So we got down move, standard deviation, um, and then we got the beta return alpha. I'm more interested in, I'll say the down move standard deviation, just because it's near the top in both of these. I don't see any beta long term. It's only short term, and I think that has a lot to do with the fact that most recently the market has not done so well, and that's why we see the rise of this beta. So let's go with the down moves and standard deviation, and let's see what's in that portfolio to see if we can find some other candidate for us to look at. Because, like I said, if GLW is not in a good place right now fundamentally, then we definitely want to stay away, meaning that our only other option is to go back into Hewlett Packard, which, it's not a horrible thing. It's a decent company. There is a little bit of fear there with that short interest and just, the idea that that PCs and desktops may actually be going away, not anytime soon, but at some point, I think we all kind of see the writing on the wall. Either we're going to have, these quote unquote desktop workstations that kind of run the house and then everything connects off of that, or everything just goes to, basically a phone that you have in your pocket that allows you to do everything, write papers, send emails, everything, and there's really no need for a desktop workstation, especially if the phones continue to get well, I shouldn't say phones, I should say portable devices get more and more powerful. All right, so this is the down standard moves. Um, and we have, wow, GLW again. So there you go. Yeah. So if GLW is in some sort of trouble, then we definitely go right back into Hewlett Packard. And if GLW is fundamentally sound, then we move into GLW as our new position, which I'm really looking forward to doing because I don't know a lot about the company and really looking forward to learning more.